Is the traditional risk versus reward relationship we've all been taught factual, or are we being misled? Or does it only apply to one method of saving, while there are others that completely shatter that idea? I don't know about you, but from as far back as I can remember, all I've ever heard is that in order to achieve higher returns, you have to accept higher risk. Of course, when looking at it through the lens of direct investment in the market, that makes all the sense in the world. And I have all this gray hair as a result of going through my fair share of market corrections, recessions, and other disruptions that have driven that message home. So is it possible that there is a different way, one that destroys the risk versus reward argument? Simple answer, yes. There are very powerful wealth building and protection tools that allow you to participate in upside growth, but provide complete protection from losses. The typical response that I hear is that that's simply too good to be true, but I can assure you it isn't. Following 2 decades of the successful track record of market indexes, in the mid-1990s, insurance came up with a novel concept. Instead of investing directly in them, they began buying market options in these indexes. This meant that only what it cost to purchase the option was at risk, because if the index didn't experience a gain, the insurance company would simply let the option expire and its clients would experience no loss, or what is referred to as a zero floor. On the other hand, if the index grew, the option would be exercised and its clients would participate in the gain. Now, you may be thinking that the gain would be minimal, but there is a 150-year-old life insurance company that right now is offering a 240% participation rate, meaning that if the S&P 500 index goes up by, let's say, 10%, its clients will receive a 24% interest credit. So how does that so-called risk versus reward relationship sound now? Until next time, be well.